Yes, it is true. The Fed lowered interest rates yesterday, but does that mean that your mortgage rates went down? The answer is sadly no. I'm Cheree. I'm your favorite lender over here at Simply Funded, and I just want to talk to you a little bit about what is happening in the market right now. So, yes, yesterday the Fed did lower interest rates by a quarter or 25 basis points, quarter of a percent. And you may think that, okay, Cherie, that means that the mortgage rates were going to go down as well. But the truth is that the mortgage rates do move independently from the Fed interest rate. The Fed interest rate is based on the rate that the Federal Reserve charges the banks. However, the mortgage interest rates actually move about 2 to 3 weeks ahead of the Fed meeting. So, in other words, within the mortgage bond community, they actually forecast what they think the Fed is going to do, and they bake those rates into what we're pricing to you ahead of the Fed meetings. So, why did the mortgage rates go up yesterday when the Fed lowered rates? Cherie, what is going on? It's honestly because the Fed surprised the market yesterday. So, yes, they did do 25 basis points lowering of the interest rate. However, they gave us a surprise because we expected in 2025 for the interest rates to go down 4 times, so a whole percentage. So every time that the rates go down, it usually goes down by 0.25% or 25 basis points. However, I'm going to show this to you here. This is the Federal Board of Governors and their interest rate projections for next year in the circled area in the red. And what is happening is that the Fed Board of Governors expects, or their committee, the supermajority of them expect to only lower interest rates next year by 0.5% or 50 basis points versus a whole percentage rate in 2025. And the truth is that most of the people in the mortgage bond industry were not expecting that. So they did turned and basically said, okay, well, we expect the rates to now be higher longer based on what the Fed said. Therefore, we are shifting our thoughts with regards to the 2025 mortgage rates. So that's what's happening. Why did the Fed make it shift? Basically, they are looking for inflation to be at 2%. However, their estimates are showing inflation still hovering about 2.5%. So they want to get that lower. And they have a mandate where they look at inflation and they also look at the job market. And even though there are layoffs happening, they don't see where the job market is so soft where they are super concerned. So they are more concerned about getting that inflation rate down to 2% than they are about the job market. So that's ultimately what's happening. They want to see over the next 12 to 15 months for the rate reductions that happened in 2024, how that's going to translate in 2025. So that overall is what happened. And look, we are still here to assist you. For a $500,000 loan amount, every time the interest rates are lowered, you do save $84 per month. However, do you really want to wait until 2026, 2027 in order to save, $30 a month, $40 a month, $80 a month? That's a decision, of course, you're going to have to make based on you and your family. But if you need assistance with any kind of real estate and you're looking for a loan, whether it is for your own house to live in or it is for investment property, we would love an opportunity to assist you. You could call or text us at this number. All righty then, thank you, and I will see you on the next video. Merry Christmas, happy holidays, and take care. Bye-bye.